You have worked 60 hours this week trying to figure out how to grow a small business. You landed new clients, you sent the invoices, but when you look at your small business cash flow, it feels like you are standing still. You are not losing, but you are not winning either. So you look at competitors and wonder what they know about how to scale a small business that you do not. Here is the uncomfortable truth. It is not a secret strategy. It is not a marketing hack. It is the lies you are still believing. I spent years inside corporate operations, sitting in rooms where business language was used deliberately to keep some people confused and others in control. The founders who build highly profitable companies are not smarter. They just stopped believing the wrong things. And those wrong things, they sound like good advice. Today, we are exposing 7 small business mistakes disguised as business wisdom. These are patterns I watched in boardrooms, audits, and in companies that looked healthy on the surface but were bleeding underneath. You are probably believing at least 3 right now. Let us dive in. Lie number 1, gross revenue is your scoreboard. In every corporate budget meeting I've ever sat in, the first number on the slide is always gross revenue. Nobody leads with margin. That is not an accident. It keeps attention on the exciting number, not the real one. Gross revenue is the vanity metric, the number people brag about. But after payroll, software, and small business expenses, a $50,000 month can leave you with almost nothing. If you want to increase profit margins, stop optimizing for applause and start optimizing for what actually stays in your account. In corporate finance, the metric that determines executive compensation is never gross revenue. It is net margin and free cash flow. Gross revenue is the headline. Profit is the verdict. Status does not put money in your bank account. Lie number 2, motivation will get you to the next level. If you are sitting in a corporate job right now, think about this. Your company does not run on motivation. It runs on systems, payroll, checklists, compliance cycles, reporting schedules. None of that exists because your employer trusts people to feel inspired every day. It exists because every serious organization knows motivation is an unreliable operational input. Your business growth strategy cannot depend on how you feel. You need small business systems, automatic transfers, invoice reminders, repeatable processes, running whether you feel motivated or not. Organizational behavior research calls this operational resilience, engineering output so the business runs independently of any single person's emotional state. Your employer already uses this principle on you. Now use it for yourself. Automation is not a luxury. It is how a small business survives a rough quarter. Lie number 3, you need to look the part to attract good clients. Corporate psychology calls this impression management, spending resources to signal status to a specific audience, the expensive office, the branding agency, the upgraded tech stack. Most of it is not for your customers, it is for your peers, and it creates business lifestyle creep, permanent overhead that grows every time revenue grows. Executive coaching programs inside Fortune 500 companies specifically address impression management as a leadership risk. They call the antidote cost discipline, spending based on utility, not optics. The best founders I have studied stay lean on purpose. They reduce business overhead costs consistently because the gap between what you earn and what you spend is not just a metric, it is your freedom. Lie number 4, it is just a one-time business expense. Almost nothing in business is one-time. Buy a CRM and you also buy integrations, consultants, training, and upgrades. That is how hidden business costs work. IT procurement teams at large companies use a framework called total cost of ownership, mapping every downstream cost before a single contract is signed. Small business owners see the headline price and discover the real cost a year later. Your stuff is billing you in non-refundable hours. The price tag is the first payment in a series, not the only one. Lie number 5, you must reinvest every penny back into the business. This sounds disciplined, it feels right, but it is dangerous. When your small business cash reserves hit that first $10,000, the instinct is to spend it, hire, upgrade, expand. That wipes your safety net to zero and locks in higher monthly costs. Corporate treasury teams call this buying from desperation. They set minimum liquidity thresholds as a governance requirement. Protecting reserves is policy, not preference. Highly profitable companies do the opposite. They protect small business cash reserves and buy from strength. Low urgency, high leverage. Cash is not there to be spent immediately. It is there to protect you. Lie number 6, you missed the perfect window. You look at founders who started earlier and think you are too late. That belief keeps you stuck, but your corporate experience is not a disadvantage. It is an advantage. You already understand risk, systems, decision-making under pressure, and resource allocation. Those are the exact skills that determine whether a small business survives its first 3 years. Research on starting a small business later in life consistently shows that founders with corporate backgrounds make fewer panic-driven, emotionally reactive mistakes. Inside corporate, this is called the minimum viable decision framework, moving forward at 70% information rather than waiting for perfect conditions. You have been doing this your whole career. There is no perfect window. The start you are waiting for is a decision, not a date. Lie number 7, being busy means you are growing. You answer emails at night, you manage everything yourself, you call it the grind. But activity is not output. This is called activity bias, a documented cognitive trap where visible busyness is confused with productive contribution. Large organizations train senior leaders out of this bias specifically because founders and executives who stay in operator mode are not building a scalable asset. They are building a high-anxiety job. Highly profitable companies are not built on the founder being the busiest person. They are built on the founder being the most strategic. There is a difference between working in your business and working on your business. Every hour spent on small tasks is time not spent on decisions that actually grow your company. Busy is not a business model. Systems, delegation, and focus are. If you recognized yourself in these lies, do not feel ashamed. Every founder has believed them, including the ones you admire. The system pushes you to chase revenue, stay busy, and spend to look successful. But the founders who build real small business cash flow do the opposite. They ignore the scoreboard. They build systems. They stay lean. They move before things feel perfect. And they get out of operator mode early. Now you know what they know. You can stop playing defense and start playing offense with your small business strategy. If this felt like I was reading your mind, subscribe. Next video goes deeper. I will see you there.